Welcome back, everybody. It's good to have you to another real estate market update for the Greater Milwaukee Area. This time already February 2025. I just got back from a trip to Chile in South America. We've been doing some hiking there in the Andes Mountains. It was absolutely spectacular. Highly recommended. January is usually a little bit slower in the real estate industry, so that's when I try to get some R&R in before the spring market hits me. And boy, did it hit already. The market was quite a bit hotter than you would expect it for this time of the year. So we'll take a look at the numbers. Then I want to walk you through some trends that are happening in the job market, because that is always driving what's happening in real estate. And then we'll take a look at home equity. As you probably know, a lot of people have gained quite a bit of net worth through their real estate. And I want to provide you with some context, because is this a good thing? Is this concerning? So context always matters. And then finally, who is buying, who is selling in Milwaukee this year? I have some demographic trends and data that I want to share with you, and then we'll take a look at what can we expect for the next few weeks here in Milwaukee. With that, let's get started with the latest numbers straight out of our MLS system. Inventory, up 21% over last year, January, but we're down quite a bit from December. So a lot of listings that didn't sell have cleared out at the end of the year. This is normal. We see this every year. And quite frankly, the 2,700 that are out there at the moment, that is very picked over. So all the buyer attention that we have right now is on a very, very small portion of that are new listings that are coming on the market that are attractive. All the other stuff has been passed up a lot. And if you compare it with the numbers below, historically, before COVID, we had around 5,000, and a few years earlier, over 10,000 inventory. So that gives you kind of an idea of how tight the market actually is. Closed units around 1,000, so that's kind of in expectation. Days on market, 21. That's also in line with what you would expect for the season. This will, the market will gain velocity very, very quickly here. We've already seen it in the last few weeks. So expect that number to come down. And median sold price, that is the big surprise actually for me, $307,000 now. That's up 9.6%. And the context here is important because this is the third month. So November, December, and January, we have seen, almost double-digit increases. So 9.6, kind of 10%. December was over that a little bit. And that is not what we expect from prices in basically the winter season. Normally you expect a lower percentage. Overall, last year came back at 8.2%, so you would normally expect something like 5 or 6% this time of the year. So the 9.6 really surprised me here. And you can see below historic prices. So basically real estate in Milwaukee has doubled in the last 10 years. The market has been very competitive in January. We have closed 8 deals in January, most of them with multiple offers. I'm not telling you this to brag, but we have a lot of experience. We see a lot of deals in the market. And so what I'm telling you is a combination both of the data that I'm analyzing every month and the research that I'm subscribing to, and also what we're seeing in the market here, working with buyers and with sellers. If you're a buyer, if you don't have to buy right now, I would say be patient, focus on your education. We're trying to build our clients' knowledge up this time of the year so they are ready for the spring market. The inventory will come. And most sellers are waiting for spring. It's interesting, every year the same pattern. Spring still feels quite a bit away, and so they're not in a hurry. The buyers are already out there, and the sellers not so much. They're still thinking about what needs to be done to get the house ready. All right, let me walk you through inventory a little bit. The blue line on the top, this is active inventory. So as we have expected, end of the year, it dropped down. A lot of the listings that didn't sell cleared out, so we have lower overall inventory, and the red line here is the new inventory that's coming in every month. Of course, very few people are listing the house in December, a little more in January, and for February and March, I'm kind of expecting an increase in listings here as we had this year. So this is a very stable pattern right now, and we should see more inventory relatively quickly here in the next month. There's not a specific point in time. It's just ramping up gradually every month a little bit more, and with that we get a more balanced number of buyers and sellers in the market. In terms of competitiveness, so we have a textbook curve here. This is the sold to list ratio. So this is basically telling you how much have buyers ended up negotiating. Did they pay over or under list price? Historically, we've been around 95-96% here. So that means a lot of people were able to negotiate a little bit. But the last few years, a lot of the time we are over 100%, which means a lot of people end up paying more than what the seller is asking. And if you see a number of 102% like we had last year in spring in average, that means that a lot of deals are actually closing 5% or 10% over list price in the hotter municipalities, West Allis, Wauwatosa, Whitefish Bay, etc. You know them. So what's happening here is throughout the year, the competitiveness is usually going down. This is why I say total textbook curve here. And then December and January, we actually dropped below 100%. So congratulations to everybody who scored a deal and was able to negotiate a bit. Keep in mind that this data is lagging a month behind. So those are deals that were negotiated in November and December and they closed in January. So you can expect this chart to go up, straight because we've already seen it, what was happening in January. And we'll see the data here next month when these deals are closing. By the way, if you can think of somebody who would benefit from this type of information and find it interesting, maybe you have a friend or family member who is thinking about buying or selling this year, feel free to share this video, and also, you know the drill, like and subscribe, much appreciated. Then what's going on with mortgage rates? Well, we are trending in that 6.5-7% range. The lowest rate that I have seen in the Milwaukee area was just a little over 6.5% with the local bank. At the moment, it is very, very tough to make any predictions. Interest rates are always tough to predict, but we have so much change going on with the new administration that I really don't dare to tell you what's going on with rates in the near future. I think we'll have to see how it shakes out, how the dust settles. The one thing that I want you to know is that it's not the Fed. We spoke about this in the last months quite a bit. It is not the Federal Reserve that is setting mortgage rates. The mortgage rates are really set by the capital markets. It's the large-scale investors that are moving billions of dollars. They are driving the bond market, and if they are nervous, then mortgage rates are going up. That's really what's happening. And I think at the moment, the market is trying to figure out what we can expect for the near future. And so, yeah, quite a bit of uncertainty with mortgage rates. My best guess is we'll stay around 6.5-7%, short of any better information. Next, let's take a look at the job market and how that is factoring into the real estate market. So we have a very interesting phenomenon going on that is called the big stay. So this is happening after the big resignation. If you remember, back in 2021, a lot of people quit their job. Companies had difficulty hiring people. Wages went up, sign-on bonuses were given, etc. So now we have something that's called the big stay. So there is a little bit of a stalemate freeze situation going on in the job market. Companies are afraid to lay people off because they are worried they can't hire them back. And workers are afraid to leave because they are afraid that they won't get hired. So, and what's happening in the job market is also reflected in the real estate market. People are staying longer in their homes. You can see here the dip that we had in 2021, and now we're back up to that 10-year number. So on average, we're looking at 9.3 years. Of course, when you look into the details, first-time home buyers, they usually think they're going to stay longer in the home, but they end up upgrading to a bigger home. What we see from our clients here in Milwaukee, oftentimes in the first 4, 5, 6 years, if you have kids in middle school or kids in high school, then you tend to stay a little bit longer. But on average, it comes out to roughly 9.3 years. And what that means is you're accumulating equity over that time. So you're paying down your mortgage, your house goes up in value, so your equity share is growing. A lot of people are paying off their mortgage. And that gets us to this super interesting statistic. So in the US, latest data from Adam is almost 40% of households do not have a mortgage anymore. And then another 29% have a small mortgage, which means less than 50% of their house is financed, more than 50% equity. Only about 1/3 have still a bigger mortgage, and they have less than 50% equity. So that is kind of good news, because that creates a lot of buffer, that creates a big safety net, and creates a lot of flexibility for people that have been in the real estate market for quite some time. Let's take a look how this actually came together. And over time. If you look at it relatively short term, so I have here the data for 1 year, you can see that on average home prices went up $5,700 last year in the US. Wisconsin did a little bit better with $9,000. Hate to say it, but Illinois beat us here with $23,000. But there's a lot of states, look out west. All the orange and brown ones here have lost equity last year. Hawaii got really beaten hard, minus $34,000. So that is the 1 year picture. If you zoom out a little bit and you take a look at 5 years, you can see things are stabilizing out a little bit more because you lose that short term up and down. On average, the US 57.4% increase over the last 5 years. Wisconsin did quite good with over 60%, and there are not that many states, we're actually beating Illinois here, and there are not that many states that have been doing a lot better than Wisconsin did. Of course, keep in mind that this is also because we started out with relatively small numbers. So if you compare Milwaukee, for example, with Chicago real estate started out higher, so it's not that easy for them to add that much in percentage. And you can also see that here when you zoom out on a little over 30-year picture here. You can see the states, the western states have gained a lot of home equity over the last 30 years. Wisconsin, 335, so we're a little better than the national average. So in summary, you can say US home prices have roughly tripled, give or take, depending which state you are, over the last 30 years. And also, most homeowners, I think, will have paid off their mortgage over the last 30 years. So that's the reason why they're sitting on so much equity right now. Now, let me take you out a little bit further. This chart shows US home prices all the way back to 1962. So that's a long-term view. And on average, this comes out to about 5.2% appreciation per year. Now, when you look back, the chart starts here relatively flat and very, very gradually, and then goes a little up here in 2007. And then went really crazy in 2021. The last few years, we've been going sideways, correcting a little bit. So if you have any healthy amount of skepticism, I know what you're thinking. You're thinking, Marcus, this does not look right. Look at the increases that we had in the last few years. Doesn't that look like a bubble? So here's one thing that I want to show you, because charts can be a little bit deceptive. Let's take a look and zoom in into those early years and see what happened. That looks very flat, very gradual. When you zoom in, you actually see that home prices went from 17,800 in the early 60s to 38,800 here in the mid 70s. And we had two recessions here. The gray area that shows you when a recession happened, home prices went down a little bit here, but here in the second recession, they just kept on going up during the recession. So a lot of people always worried, well, we have a recession. Does that mean home prices are crashing down? No, usually not. 2008 was a famous example. We'll take a look at that. But before I get there, let me show you something else. I was trying to find an actual advertising from a house that was listed for sale in May of 1960. And this is advertising from a builder. So this was a spec build, and they're advertising it for $14,990, including air conditioning at no extra cost. And you could buy it for $390 down. And of course, people would buy this, and that was a lot of money for them back. Today you might put this on a credit card. Back then, they actually took out a 30-year mortgage to pay this off. Now, if you would have told that buyer at the time, you're buying it now for $14,990, and then in a few years your home price will have doubled, they would have looked at you as if you're a little crazy. But we know from history that is what actually happened. And if you want to know what happened during 2008, so this was arguably the worst 10-year period for real estate. If you were unlucky enough to buy a house in Q1 of 2007, which was the peak before the crash, this was the subprime mortgage crisis, and then that led actually into an economic recession that was triggered by a real estate crash, you would have to wait all the way here until roughly about 2013. So there was no 10-year period in time in the US where real estate did not gain value. So the reason is not necessarily that homes go up in value so much. The reason behind it, if you really investigate it, is actually that we're devaluing the dollar every year. With inflation, you have to bring more and more of the paper dollars in order to buy the same goods and services, and real estate is a hard asset. That is why over time, as the dollar is losing value, the prices for real estate tend to be going up. So that's when you zoom out on a macro level, this is why that is happening. I hope this makes some sense and explains a little bit what's going on with value. Let's take a look at who is buying and who is selling. So 75% of all sellers are over 50 years old. They're older than me. I just turned 50 this year. And still sounds weird saying it out loud. But 75% of people who are selling real estate are over 50. We have some Gen X's here that are selling, but the majority, if you look here, these are the young boomers. That's the biggest group, and the older boomers here with another 90%. So if you combine the boomers together, it's very clear boomers are the number one generation that are selling. That's where all our inventory is coming from. And if you look who is buying, then you will see 65% of all buyers are under 50%. And you can combine here the older millennials and the younger millennials together. They are the biggest group. And then you also have some Gen X's that are buying. And boomers, young boomers and old boomers combined here are also a substantial number, because most boomers, when they're selling their home, they're actually downsizing from a big 5-bedroom in Mequon and they're buying something smaller downtown or condo, for example, or in Tosa. And oftentimes they are competing with first-time home buyers. So this looks like this. This is our Milwaukee population, about 1.6 million people. And 348,000 of them roughly are boomers. So this is the number one demographic age group that is currently selling. And on the buying side, we have number one millennials, but we also have some Gen Zs that are already buying. And we also have some Gen X that are buying. And it's very easy to see just physically that the group of sellers here is a lot smaller than the group of buyers. And that is kind of the overall trend that is driving this. We also have to bridge the gap here. I do this all the time with my sellers. If you have lived in your home for 10, 20 years, what upgrades and what adjustments and what do you need to do to get your home ready in order to sell it for maximum price to millennials or to Gen Xers without spending too much money, because you want to see a positive return on investment. All right, what can we expect for the next few weeks here in the Milwaukee area? First of all, inventory is on a seasonal low right now. That's what it is. It's very picked over, so only a very small percentage of those listings are attractive and they're getting a lot of attention. So if you're a buyer right now and you don't have to buy right now, then be patient. There is going to be more inventory in the next few weeks. Use the time to get prepared, get educated, hop on a Zoom call with me. We can discuss your personal situation and come up with a good strategy that, puts you in a good position to compete in this market. Mortgage rates remain a little bit uncertain. My best guess at the moment is somewhere around 6.5, 7, maybe a little bit over 7%. But the capital markets need to figure out in what direction we're going. And until then, it's very difficult to make any educated guess of what is going to happen there. If you're a seller, right now is a good time to prepare. Spring is coming up quicker than you think, and there's already a lot of buyers in the market. So the first question that you typically want to answer is, how much equity do I have? How much is my home worth? So you know what you have to work with, what you can plan with your next move. That's a little bit of work, but I don't mind doing it. Putting a CMA, comparative market analysis, together for you, so you know exactly how much your home is worth, and then you can decide if you want to put it on the market, if that's a good strategy for you. Second question is always, should you make some improvements? Especially, we talked about the generational shift. If your house hasn't seen any upgrades in the last 10 or 20 years, the question always is, which projects are worth it? Where should I spend time, money, and energy? More often than not, I have to talk sellers out of doing some projects that will not deliver a positive return on investment. So we have to go through it and look at it case by case. Happy to do that. If you want to, you can go on our website and download some of our free guides. We have a buyer guide, we have a seller guide, we have a Milwaukee relocation guide, and you can also request access to the MLS. All of that on my website, onpointrg.com. And if you're thinking about a move, then I would definitely say, give me a call. You can just go on the website and click on the schedule a call button, and you will have access to my calendar, so you can see what time slots I have available, and you can pick a time that works for you, and then we can hop on a phone call or on a Zoom call, and I'm looking forward to it. Thank you very much for watching, and I'll see you next month.